Okay, so today's Cardinal lesson, I'm here with my associate, Tom Griffiths, CFP, and we're talking today again about hybrid long-term care insurance and a specific kind of it. And by hybrid, I mean the policy that we're speaking about today is an almost $300,000 life insurance policy. And then it is an almost $600,000 long-term care policy, and it's funded entirely by one $200,000 transfer of an IRA money. So I think you're going to be real interested in this.
And so, like John was saying, this policy uses IRA money and 401k money. And so, what's unique about this is the only company that offers a hybrid policy that we have that does this. And most retirees come in, and this is where the bulk of their savings is in 401ks, is in IRAs. And so, it's nice if we can use some of that money into a policy to help protect them from the long-term care. And so, like John was saying, or Hans was saying, the policy has an initial transfer of $200,000 from your IRA to or 401k to an IRA with this insurance company that they in turn pay out of that a premium into a life insurance policy that has a long-term care rider. So I'll let John speak a little bit more to how that transition works.
I mean, so why is there a need to come out with a policy like this? I mean, why do you have to get the money from an IRA? And the answer to that is that's where the money is. A lot of the clients that come into us, they have fairly large IRAs, and they have smaller or smallish amounts of non-qualified money, or money in a brokerage account, money in a savings account. So generally, that's where the money is. And so people that are, in this case of these clients, this guy's 59 and a half, so he's at the minimum age to buy this policy, because you can't really buy this particular policy if you're younger than 59 and a half, and he's there. His wife is just a little bit younger. And so what we're showing him, and his IRA money is a couple of $1 million. It was approaching that. And so he can fairly easily carve off $200,000 of his IRA money, or it's actually some of it's still in a 401k. So wherever we get it from, he can carve that out and commit it to this problem.
And what you get for that is a $200,000 or almost $300,000 life insurance policy that's funded out of that $200,000 IRA. So what they do is they take the $200,000 and they set it up in an annuity at this company that pays out 10 annual payments into the life insurance policy. So that 10 annual payments is a little bit more than the 200 you put in over the 10 years. It's $22,000 a year for 10 years. How that gets split up is about $15,000 or $14,922 goes into the life insurance policy, and about $7,000 of that money is going into the long-term care policy that doubles the life insurance benefit for long-term care. And so it's
Here's what I want you to get out of this. You put in $200,000 of IRA money right from the beginning, and you're done paying. That's it. Now, you're not putting all 200,000 straight into the insurance policy or into the life insurance and the long-term care, because if you did that, you'd have to pay taxes on $200,000 all in 1 year. You're moving it and transferring it by rollover, 200,000 where it is. That's what this client's doing, and he's moving it into an IRA annuity that's inside of this whole arrangement. So there's no tax on that. And then from that, over 10 years, they're going to deduct $22,000 a year, or $220,000 of that original $200,000. So this account after 10 years is going to be at zero, the $200,000 IRA annuity. And then the life insurance is going to have all the money inside of it.
And so what you get, how this actually works when it's time to file a claim, you need long-term care, is this policy will pay out almost $9,000 a month for either spouse. So this covers both of them. You could claim it at the same time, but it's $9,000 per person if they need care. And how you qualify is you need help performing 2 of the 6 activities of daily living. And so once you qualify, it sends you $9,000 a month to pay the care. Again, it covers both spouses, so both could be collecting the 9,000 at the same time, and that will last for 66 months or 5.5 years under the policy design we have here. And that is just that or the $600,000 divided by 9,000 is 66 months. And so what you get for this, just in summary, is an initial transfer of $200,000. If you don't need care, which we kind of hope we never need care, your beneficiaries at least get $300,000 tax-free in a life insurance benefit. And if you do need care, which is really why we're buying this policy, it will provide $600,000 worth of benefits paid out over 5.5 years for either spouse.
So let's get this straight again. I put in 200 grand. I don't pay any more for the rest of my life. And what I have is a $300,000 life insurance policy. That's providing I never need long-term care. And the long-term care is why you're buying it in the first place. But for these people that say, well, I don't want to put all this money into this and then I'm going to fall over, pass away, never collect a dime out of it. Well, yeah, that's correct. If you pass away, you won't collect a dime out of it, but your heirs are going to get $300,000 tax-free. Now, understand this is covering 2 people, covering this husband and this wife. So it's going to be after the second one dies that the payout of the life insurance, and it's going to be the second one dying with neither one of you collecting anything out. If you do collect something during your lifetime, let's say one of you had long-term care and it was just for a short period of time, like 6 months, and the policy paid out $40,000 over that 6 months. Well, then the second one of you passes away. So instead of a $300,000 policy, it'll be a $240,000 policy that'll go to your children.
I'm going to switch over now. We're going to look how this actually kind of works behind the scenes here. So we're going to show you here what's actually happening. And so what this is showing is what's going on, that $22,000 a year, how that's being paid out. So I want to point out that the cash surrender value in the policy, so if you canceled this in the second year or in the first year, which again, you don't buy this with the intention of doing it, we'd really never see this happen. But there is still a large portion of your account balance you've put there that is still available to you. The point I want to show is that decreases over the first 10 years as it's paying that $22,000 out of the $200,000 policy there, the transfer that you did. So after the 10th year, the cash surrender value is essentially the cash surrender value of just in the life insurance policy at this point, because the IRA has been depleted. It's all in the life insurance policy at this point. And then it has a growing cash surrender value because the life insurance cash value does grow over time. Another way you can look at this is the total death benefit. If both of you were to die in the first year, you have a large chunk of that $200,000 still there that your beneficiaries would still receive. It's still in an IRA. They would receive it tax deferred, and it follows all the other IRA rules there. But 298,000 of it is going to be tax free from a life insurance death benefit. And so you can see the death benefit is declining again because that 200,000 is being depleted. But then we get to the 10th year and it levels out at the 298, and that's the benefit they would receive if neither one of you needed long-term care and you both died. This is what your beneficiaries would get. Again, the real reason we're buying this policy is the long-term care benefit. It's almost $600,000 immediately from day one. And again, that gets paid out at almost $9,000 a month per person, and that lasts for 55 or 66 months.
Yeah.
5.5 years.
Yeah. Now, the thing that we looked at is if you can, this is one of the few companies that offers a lifetime or unlimited benefit. So we just don't want you to choke at the money in the example, but we've had a number of people do this as they upsell themselves or they buy more of it. And if you look in here at the numbers, up there with the $200,000 IRA that you put in there by transfer is being transferred over into the life insurance and long-term care insurance, you'll notice that's 22,000 a year, and that's broken down 14,922 a year for 10 years goes into the life insurance, and $7,078 goes into the long-term care insurance. If you would be willing to pay another $6,000 a year for the long-term care insurance, we can remove that 66-month cap or that $598,000 cap, and it becomes unlimited. So what that would do is up the 200 grand to about 260 grand of IRA money that you need to move over there, and then you could make an unlimited policy where both of you could be in there or collecting at home, because a lot of people are going to use this currently and in the future for long-term for home health care, but there's no time limit on it on the unlimited policy.
The other thing I will point out is this is a pretty beefed up policy. This is a lot of benefits. And so you don't need to buy a policy that has this much benefits. As you could do something a little bit less. You don't need to insure the full risk. You can insure half of the risk. I mean, there's a lot of flexibility in this. And so don't get scared off with the 200,000. Again, what Hans was saying earlier, this person had the money, they had the funds to be able to do this, and they were worried about the long-term care risk. So it made sense for them. But if you don't have an IRA that large, but you do want some coverage, this could be a way to do it.
Yeah, and also the age 59 man and 57 woman, a lot of people watching us are older than that. You're saying, well, yeah, this is great for them. How much does this thing cost for me? Well, if you're 65, I'm just going to, both of you, or 64, which is when a lot of people call us when they're just coming into Medicare and they come to us for financial planning. I'm going to tell you that probably it's going to cost you, when you add 5 or 6 years, we could go to $250,000 and you're going to get the same benefits. Or another way to look at it, you could put the same 200,000 in there and you're just going to get smaller benefits. These other numbers over to the middle are going to reduce by a bit. So a lot of times we do start with the money, with the amount of money that the people are willing to commit to this out of their IRA. And then we see what kind of benefits you can get with that. And there's a lot of things we can move around: the length of coverage, the amount of coverage. So there's a lot of negotiation that goes on of getting the exact right policy for you. And I just want to add to what Tom said: is it just don't let the money scare you. Is we have ways to do part single premium and part ongoing premium to make the lump sum of money smaller. And if you do have money outside of an IRA and a pretty good chunk of it that you could commit to something, it's actually better to use non-qualified money, and it would open up a whole assortment of different companies besides this one to offer it to. So this thing is really set up to use with single funding from IRA money.
Yeah, and I think we mentioned this also, but another thing just to remember is this $22,000 that's coming out of the IRA. You're paying taxes on that $22,000 as it comes out in those 10 years. And so where this also fits in with a lot of the clients coming in is they're coming up and we're helping them come up with a strategy to lower their account balances in their IRAs because they've saved well, they have large IRAs, and now they're looking at the tax implications of that and they want to start winding them down. So this fits nicely within that strategy of trying to get something that's moving money from tax deferred, money you have not paid taxes on, over into something tax free, like a life insurance policy.
But yeah, and I'm just going to add, when your beneficiaries are collecting this 300 grand of death benefit, if you buy this thing on your spouse and you, and then you both pass away without using it, that 300 grand is tax free to your kids. I mean, it's not like inheriting IRA money. I mean, there's not a whole bunch of tax implications. And then if you do use it for long-term care, which is what you're buying it for, that long-term care benefit comes to you tax free. And so that's big time. And so you're really, most people that come to us that have a bunch of IRA money, we're pointing out the problem. Okay, you've done great. You got savings. What's it for? And then it's been for postponing taxes all along. Well, now you're getting to retirement. And if you pass away with a whole bunch of money in your IRA, you're creating a tax problem for your kids. And this can be part of a larger strategy of just shifting money from the tax deferred side of the bucket to the already been paid tax or tax free side. So, listen, it's been great talking to you folks today. I'm Hans Scheil. This is Tom Griffith, and we thank you very much for listening.